Welcome to a special edition of Bondcast, brought to you by NatWest. My name is Tim Phillips. The regular presenters have let me sit in today because we're doing something a bit different. We're looking ahead to what might happen in the Bondcast universe next year, 2026, and what that means for you. However, the regular presenters, they're here with us. So hello, Paul Robson, head of G10 FX strategy for EMEA.
It's great to be here.
And hello to Joann Spadigam, European rates strategist for NatWest Markets.
Excited to record.
And down the line from the States, hello to Stuart Sparks, head of US rate strategy at NatWest Markets.
Hi there.
If you're wondering what the Bondcast universe is, it's kind of like the Marvel Comics universe, but with bonds. So if you could think of your superhero name by the end of our podcast, I'm going to be Captain Questions. Hang on.
Captain Questions.
Today, asking what's next for bond markets in 2026. Paul, I'd like to start with you because when we talked about this, you said the huge story is funding the deficits. On the supply side, what sort of scale of issuance are we looking at 2026?
In the UK, that supply is going to be, once again, very, very heavy. It might be a little bit less than we had this year, but I think people have to be mindful of the fact that it's still going to be multiples of levels of supply that we had before COVID. And I think people forget that. They look at the change year to year, but it will be a year where markets are going to have to absorb an awful lot of supply in the UK. And again, it's going to be, where does that demand for UK government bonds come from? Because we know that that landscape is shifting. For total issuance, net of redemption, we'll be getting a number of around 120 billion. That's down from around 150. But again, the average number of issuance in the UK was about 50. So we're talking twice as much as we used to. We have to be mindful of the Bank of England's QT policy. There's no longer QE, quantitative easing of purchases of bonds, but net selling. And the Bank of England has extended that. They rolled it over 70 billion. So you're already adding on 70 billion. And the debt servicing costs that the UK faces, a lot of borrowing, lots of redemptions with sticky inflation, a high policy rate from the Bank of England. And it means that that issuance is going to remain really quite elevated.
Looking across Europe, Joann.
So in Europe, in the euro area, there's another year of pretty hefty issuance as well. So I see something like 1.3 trillion in terms of gross supply for next year, in gross terms higher than it was for this year. But I think in net terms, it's broadly similar. There's a pretty high year of redemptions upon us, which I think does mean a net term supply is a bit lighter. Zooming out into the European picture, it really is all about defense in Germany when it comes to spending for next year. Germany has, of course, announced a pretty sizable fiscal package earlier this year. And I think that question around how they decide to issue will be an important one for next year. Other countries have been less excited, I would say, about this. Spain, for example, has pushed back quite significantly against spending that 5% NATO level. But I think that Germany, they've got the fiscal space here, so they will be doing the heavy lifting. And that does mean that German funding specifically will be pretty elevated for the many years to come. So what does a German spending package essentially mean for Europe as a whole? That would be a big question. And I think the second important thing is as well how the rest of the euro area will really compensate and spend on defense. And I think NGEU and the EU tool is an important tool here. They can essentially mean that smaller countries who don't have the fiscal space can use EU funds in order to be able to raise cash for defense going forward. Similar to Paul, there's a very big demand supply story as well in Europe that needs to be thought about and I think addressed going forward.
Talk to me about that. Where's the demand coming from?
So the demand side, I think, is going to be shifting quite drastically next year. And that's a structural shift. We've, of course, had ECB QT running for a while now. But I think that the next big topic will be pension fund demand and how that shifts. The biggest pension funds in the Netherlands are going to be transitioning next year and in 2027. And what that means is a shift in demand from long-end bonds, essentially, to something a bit shorter down in the curve. So that leaves a bit of a question around who will buy long-end bonds. When I'm thinking about the demand side, there can obviously be compensation in some respects. Foreign investors have been a big buyer since QT begun. There's this broader question around allocations out of the US into the euro area. Perhaps we get reserves moving from dollars to euros and adding to demand for European duration. But again, this is not a short-term issue. This is a much more long-term thematic issue. We've not really seen big selling in US Treasuries so far. The story is one that will be drawn out over the next few years. Retail has been a big buyer. I think Italy has been a very good example of this, where tax incentives can help to induce retail buyers to essentially step in and buy government bonds. Banks as well. QT is reducing the amount of reserves in the system, and that does mean they've got to compensate somehow. And of course, sovereign debt is very high quality. So all these actors could buy a little bit more in the next year. But these demand actors will be much more focused on the shorts and mediums, whilst actually the reduction in demand is at the very long end. And I think debt management offices need to be quite proactive about changing the maturity schedule of the issuance. And that's just not something I think that is happening. So I think the weighted average maturity of supply will be pretty much the same for 26 versus 25. But I think that weighted average maturity not shifting will essentially be what causes curves to steepen into next year.
That's what I was going to ask you about, Paul. That's something you've been talking about on Bondcast for the last few months.
I think that that's a global theme, steeper curves in the US and in some markets in Europe. But I think for the UK, you have to be careful about which bit of the curve you think will be steepening. So we do think that supply will be heaviest at around the 10-year sector. And that's where we think you might get this curve steepening. You might have the Bank of England continuing to cut, but there's going to be this pressure. But at the long end of the curve in the UK, I think that the DMO, as well as the Bank of England and financial markets generally, understand that there is much more reduced demand for long end bonds. It was super interesting listening to Joann there, describing the differences between Europe and the UK, compare and contrast. It sort of takes me back to my A-level economics papers, and that used to be a classic question. So we don't have a lot of long-end demand in the UK, but that's absolutely fine because it's understood. The DMO has reacted, unlike DMOs across Europe, and they will issue where demand is deepest. And there is demand for UK government bonds. They would need to be, because gross supply has been 300 billion this year. One of the themes that I think doesn't get enough attention is the demand for gilts from bank treasuries. I think that's related to the Bank of England's management of its reserves, how they put reserves into the banking sector, and also crucially, its overseas demand. And there is a global market for bonds. It's about the clearing price between that increased supply shifting demand. There will be a clearing price and a clearing yield. And 2026 will be about where that is. But in terms of your direct question, we think that 10s, 30s can actually flatten while it looks like it might steepen elsewhere. But that 2s, 10s part of the curve, we think steepens.
Right, I'm glad I didn't do your economics A-level. I might have struggled. Stuart, in the US, what's the equivalent story? US 2026 issuance?
We expect net coupon supply of 1.5 trillion, which is essentially unchanged from fiscal 2025. That being said, the deficit is modestly higher for the year, and we expect the Treasury to make up that difference via higher bill issuance. We expect net bills outstanding to move from about 400 billion to around 550 billion over the course of the year. Within the unchanged net coupon supply, I suppose this makes sense. We also expect coupon sizes to remain constant across the curve for the duration of the year. And in fact, this is consistent with the November 2025 refunding from Treasury. The expectation that auction sizes will remain constant, at least for the next several quarters. We think that will carry on through the balance of 2026.
What about yields?
Well, we're bearish. We see 10-year Treasury yields going from 4% to about 4.70, 30-year yields going from 4.80 to 5.80. And within that, we see a significant amount of curve steepening. We have 530's curve steepening to 195 basis points, which is order of magnitude about 100 basis points above the current forwards. So there's definitely a story there, we think.
We were talking about the potential for a US policy mistake in 2026.
Well, I think there's some nuance here because what might classically have been construed as a policy mistake, I would argue rather is becoming policy. And there is a key shift here in our minds. We think the political imperative is for faster nominal growth. This is just in terms of economic well-being, but also debt sustainability. And one of the keys to getting to faster nominal growth will be, I think, a more receptive view of modestly higher inflation. So when we look forward, we don't necessarily think that stimulative policy, both monetarily and fiscally, is a policy mistake. Rather, we think it's an effort by the fiscal authority to maximize growth momentum going into 2026 midterm elections.
What's the consensus in the room about this? What do you think, Paul?
I think that the risk is really there. I think undermining the independence of the US central bank, that sort of change in reaction function where the Fed may prioritize growth over inflation, I think that could have a meaningful impact on risk assets globally, certainly in the first half of next year. And also, if it does turn out to be a policy mistake, then that is going to have to be dealt with potentially at the end of next year. And that's going to certainly make the recording of the year ahead, 2027, certainly interesting at level. So we'll come back in a year and we'll find out whether it was, in fact, a policy mistake. It does feel like the policies in the US are inflationary. And if growth isn't as weak as the Fed turns out, or the labour market isn't weak, you're going to get a nasty combination of high inflation, recovering growth, and a central bank that's cut rates really quite aggressively. I think that's certainly going to be one of the stories for 2026.
It's an interesting dynamic here, given that Stuart has mentioned a pretty significant steepening of the US curve. And that does add a global aspect to the curve steepening when I'm thinking about the 10-30 spot of the curve as well. But I think, interestingly enough, in Europe, when it comes to fiscal policy and monetary policy, there will be an interesting shift next year where I do think that what really will drive the next stage for ECB policy will be where growth ends up, and that's really driven by this fiscal package. So monetary policy is in a very different place, I would say, in Europe versus the rest of the world at this stage.
I want each of you to give me an indicator that we should be watching in 2026 based on what we've been talking about so far. Something that we should be looking out for. Maybe it's going to test whether or not what you've been saying is going to play out or not. Joann, you start.
Just looking at where growth is in Germany. So something we'll be watching for is looking at Germany essentially has some data on how they're actually funding defense spending. So we'll be keeping an eye on that. And then, of course, I think the forward-looking indicators on growth will be important. So PMIs, consumer surveys, and all of that good stuff.
Stuart, what are you going to be watching out for?
Well, we think we're on the leading edge of a structural change in how the Fed reacts to and manages inflation. And so the surprise for 2026 that I'll be looking for will be changes to that Fed reaction function. And here, what I think is most likely is some change in the definition of price stability. Price stability is the mandate for the Fed in its charter. The definition of price stability, though, is determined by the Fed. And pursuant to this idea of a greater tolerance for modestly higher inflation, we think that we could see some motion on the definition of price stability, which is currently 2% core PCE. That could become a higher number, say 3%. That could be a range, 1% to 3%, something like that. Those sorts of provisions we can observe elsewhere around the world. And I think that modest changes in inflation tolerance over very long periods of time have profoundly helpful implications for debt sustainability and the path of fiscal policy. I think one of the things that we've learned from the sovereign crisis in Europe is that austerity is very difficult politically. And in that sense, we think that inflation is simply too good a deal for politicians. And given the demographics and fiscal obligations, we effectively think that the Fed will more or less underwrite some of the fiscal responsibility, effectively financing those responsibilities with higher inflation.
It will be fascinating to look out for some of those changes, things that might have been inconceivable not so long ago. Paul, what would you be looking out for as an indicator?
I think in terms of that US policy mistake, whether it actually turns out to be true, I think you're led to the gold price and to what extent that continues to rise, whether it's fiat currencies under pressure, whether it's de-dollarization because that US institutions are being undermined. Obviously, the gold price moving higher has been a key theme for financial markets. We've had a correction. We'll be watching that very carefully to see whether that recovers. In terms of the UK market, it's going to be the month-to-month borrowing numbers, because we suspect that we'll get a budget where we get a set of more credible economic projections, productivity, borrowing. We suspect that that comes with quite significant tax increases. But the risk is that once you've done that, if borrowing continues to overshoot those new, more credible forecasts, and you've already raised taxes, then I think we have to move on to political risk. And next year has a number of possible flashpoints in the bond market, local elections, for example, next year's budget. So for the UK, definitely watching the borrowing numbers, because this year, one of the themes has been you've had these revisions to economic projections and the ink is almost not dry on the new forecasts, and yet they're coming under pressure. But for me, it's the gold price.
Okay, I also want to ask you about a news story that's cutting through. It doesn't just exist in your universe, it exists in, well, everybody's, and that's this debate over central bank independence. Again, one of those conversations that a few years ago, maybe we didn't think we would be having. This is particularly a story in the US. Stuart, is Fed independence genuinely at risk in 2026, do you think?
I think it is. And as I said, we think we're on the leading edge of a structural change. And there's a profound reason for this. The policy equilibrium that we are stuck in is due in some fashion to the lack of collaboration between fiscal and monetary authority. And what we get as an economic equilibrium from that is expansive fiscal policy and restrictive monetary policy. And that's not suited to the demographic structural change that we're undergoing. In this world where there will be more elderly citizens taking out of the system than paying in, we need a productivity miracle. And to get that productivity miracle, we need investment. And to get investment, we need low real yields. Unfortunately, the equilibrium that we're in is characterized by high real yields and higher interest rates. And so I think given the challenges we and other industrial economies are facing, it's rational to think that institutions will evolve to produce the sort of economic equilibrium best suited to those challenges. And again, in order to get an economy suited for investment that will produce productivity and enable us to balance the books and care for the retirees in particular, I think this is highly likely. Now, in 2026, in terms of formal structural change, it's less likely simply because of the issue of time. But as I said, telltale signs of this drift could be seen in more temporal measures like changing the definition of price stability, as I previously mentioned.
Stuart, you're talking about this in a very rational, policy-aware way. The news story at the moment about Fed independence is rather more political and power-based, isn't it? Can we make a difference in what the impacts of the policy, if it's enacted for either of these motivations, would be?
Well, it's no surprise to me that you're seeing the fiscal authority, which is the administration, begin to sort of lean over the guardrails. And the reason is because the onus of stimulus has been on the fiscal authority, and that fiscal authority is largely out of headroom. We're at debt to GDP levels of something like 100%. For example, the CBO, the Congressional Budget Office, which does a lot of the forecasting and scoring of fiscal packages, and their long-term debt projections implicitly forecasts the growth rate of debt service to rise above the growth rate of nominal GDP in 2044, which is the definition of explosive debt. So given that lack of headroom, it's entirely rational, I think, to see a more aggressive fiscal agent trying to extract greater stimulus from the monetary authority. And I think that's what we're seeing in real time.
Joann, you already mentioned that the fiscal package in Europe is going to be important next year? Are we going to see more interaction between monetary and fiscal policy in Europe?
Not to the same extent as the US. I think that clearly Europe sees an opportunity from what we are having in terms of more political and policy volatility in the US. And I think that the ECB probably wants to be seen as a stable central bank and wouldn't necessarily want to be interacting too much when we think about fiscal and monetary policy. But I think the way in which it matters in Europe is just in terms of how we see growth evolving over the next year. Unlike the US, unlike the UK, I think the ECB is clearly done with their monetary policy for now. They've indicated they're happy at 2%. And the key question for next year will essentially be what happens next. And here's where I think the growth picture becomes important. If they are able to achieve a better picture for growth, that does mean perhaps that real rates will have to correct upwards, or that we could even be talking about hikes at the end of next year.
Hikes. Gosh. Paul, how do you see this playing out and the consequences of this for bond market?
The UK quite often gets a bad rep on lots of different metrics, but I think independence of the central bank relative to fiscal policies is an area where that's not deserved. The Bank of England is independent. You see that through their QT programme, actually. I think the decision to extend it at a time when bond markets were under considerable pressure, they continue to separate monetary policy from fiscal policy. They don't want to be seen to be changing what they're doing in terms of monetary policy because of the budget position in the UK. But they're, of course, linked. And you've seen that just in recent days, the prospect of higher taxes to fund a larger shortfall in the government's budget. But if that is front-loaded, if that is through income tax rises that has an earlier, more meaningful impact on the economy, then the Bank of England will ease policy a little bit more aggressively. And that's what markets have priced in. So at the moment, I don't see it being a big impact in terms of independence and credibility, but they are totally linked. What we've seen recently is we've had the gilt market actually outperforming. Spreads have narrowed relative to Europe and the US. 10-year yields are actually lower now than they were at the beginning of the year, which is quite important to note. But that front end is moving lower and it's pinning the curve lower. So at the moment, I think monetary fiscal policy in the UK in terms of the bond market is working as you would have expected it to, or hoped that it would have worked.
I want to ask you to tell me something that's on your agenda for 2026, something that maybe the rest of us aren't thinking about yet, but will be important. Who's going to go first? Joann, you're making eye contact.
I should really avoid doing that. I think that the one point we haven't talked about very much so far has really been on spreads. And I think here's where I really see a continued theme of periphery and semi-core convergence. It's something we've seen for most of this year. I think Italy and France has converged quite nicely for now. But I really do think that there is room for this to continue, essentially. I think dynamics have been improving when it comes to debt and external trade balances as well when it comes to periphery. And ratings have been catching up as well. So there's not really much in the way, I would say, in terms of momentum when it comes to spreads going into next year. France, of course, does remain the elephant in the room. And here I think that political risks will continue. There doesn't really seem to be a clear reason for that not to be happening, I think, unless there's a new set of elections, new set of presidential elections even, which is clearly much farther down the line.
We're talking about France with political risk and contrasting it with Italy. Who thought this might happen? Paul, what's on your agenda?
For me, it's the relationship actually with FX reserve diversification and de-dollarization. And if money is to leave the US, where does it go and into what asset? And when we started this podcast talking about supply and where the demand will come from, that shifting demand from FX reserves, I think, can be a defining theme for next year. If the dollar doesn't weaken as we expect, if we don't get FX reserves moving out of dollars, then it's going to be more difficult for these developed economies to find buyers for that supply. So I'll be watching very carefully about how FX reserves are shifting over time, because the numbers were enormous here. $4 trillion of FX reserves. The dollar makes up just under 60%. So you get 1 or 2 percentage shifts in FX reserves, and that can make a big difference to how the UK funds its supply in 2026. So for me, de-dollarization, FX reserves is a key theme to watch.
Stuart.
We have the view that growth will accelerate more materially than even is reflected in our house forecasts, and even more so with respect to the Fed. We've done some work that suggests that a weaker currency, lower policy rates, the credit impulse, the fiscal impulse, and financial market incentives for investment would drive a material acceleration of real growth from under 2% in the beginning of 2025 to between 3 and 3.5% by mid-year next year. And I think the importance of that sort of growth performance relative to consensus would be increased cyclical pressure, upward pressure on inflation, which coincides with structural changes that make the economy more inflationary and with uncertainties about the policy reaction function that we've discussed. So we think that growth could be a key catalyst, and we expect consensus to rise over the course of 2026.
Thank you all very much for your views. Joann, thank you. Do you have a superhero name?
Bond Vigilante.
Fantastic. The Bond Vigilante. Paul, what's your superhero name?
I think best to switch franchises, actually. So I can remember walking into the dealing floor 30 years ago at NatWest, and we all had nicknames back then. And mine quickly became Frodo because of my similarity to the character out of the Hobbit franchise. So I'm going to just go back to the Hobbit.
You carry a heavy burden, Frodo.
And Stuart, for you?
My superhero name. I'm amenable to suggestion.
And if anyone wants to write in and tell us what they think Stuart's superhero name should be, we'd be very pleased to hear it. Thank you to all of you, and the Bondcast team will be back soon.